There's that old saying that if we don't learn from history, we're doomed to repeat it. Well, in the world of finance, it seems like we sometimes have a really short memory. So today, we're going to crack open one of the biggest financial stories of our lifetime, the 2008 crisis. And it all boils down to this one kind of mind-blowing question. How on earth did a simple home loan, the thing people use to buy a house, probably the most stable part of the economy, how did that become the trigger for a catastrophe that brought the entire world to its knees? It seems impossible, right? Well, that's exactly what we're going to figure out. So let's rewind the clock to the early 2000s. The dot-com bubble had just burst, and investors were seriously spooked. All they wanted was to find a safe place to park their money, somewhere reliable where they knew they'd get it back, hopefully with a little extra profit. And when you're looking for safety, what seems safer than a good old-fashioned mortgage? I mean, think about it. You lend someone money, they pay you back every single month with interest, and what if they don't? Well, you get to take the house. And since real estate prices only ever seem to go up, it felt like there was literally zero risk. What could possibly go wrong? Okay, but here's the thing. A huge investment fund doesn't want to buy just one mortgage from some family down the street. They're playing with millions, even billions of dollars. They need something way bigger. And that's where the big investment banks saw a massive opportunity. They decided to step in and build a machine. So the banks got to work building this incredible financial profit machine. They figured out a way to take thousands of these little home loans and bundle them up into these giant, shiny investment products that they could sell all over the world. And believe me, the demand for these things seemed absolutely endless. And the pipeline they built was honestly pretty ingenious. It was this perfect loop. A local bank makes a loan, but instead of waiting 30 years to get paid back, they immediately sell it to an investment bank and get all their cash right back. What does that mean? They can turn right around and lend that same money out again and again and again. It basically put the whole mortgage industry on a hyperdrive. And this was the key product right here, the mortgage-backed security, or MBS for short. The investment bank takes thousands of home loans, mushes them all together into one giant package, and then sells little slices of that package to investors. All of a sudden, a home buyer in Florida is making their monthly payment, and that money is going directly to an investor in, say, Germany. Pretty clever, right? At the time, everybody thought so. And this machine just kept getting bigger and bigger. It wasn't just the private banks. Everyone got in on it. Even government-sponsored groups like Fannie Mae and Freddie Mac started buying up these mortgage products like crazy, all to encourage even more home lending. The demand was just off the charts. Now, whenever you have this much money flying around, other people want in on the action. So the insurance companies cooked up something new called a credit default swap, or CDS. You can basically think of it as an insurance policy on a mortgage. An investor pays the insurer a small fee, and if that mortgage ever goes bad, the insurer pays the investor a bunch of money. For the insurance companies, this looked like the easiest money they'd ever make. Now, at first, the market for these insurance policies was huge, but, maybe manageable. We're talking about $900 billion worth of mortgages being insured. That's a massive number for sure, but it was really just the beginning. Because things went completely off the rails. That $900 billion ballooned to an unbelievable $62 trillion. How is that even possible? Well, people weren't just buying insurance on their own investments. Speculators started making side bets, buying multiple insurance policies on the same mortgages they didn't even own. It was like taking out 10 different fire insurance policies on your neighbor's house. As long as it doesn't burn down, you just collect free money. But here was the fatal flaw. The insurers did not have $62 trillion to pay out if things went south. And this brings us to the core problem, the fatal flaw in this entire system. Because everyone was just passing the risk on to the next person in line, nobody, and I mean nobody, had a reason to be careful anymore. They were building a giant time bomb right in the middle of the global economy. And this is the part you really gotta understand. Once a local lender sold that mortgage to an investment bank, it wasn't their problem anymore. So why would they care if the person taking out the loan could actually afford to pay it back? The risk was now sitting with some investor thousands of miles away. This is something called moral hazard, and it's a huge deal. The only thing the lenders cared about was making more loans to collect more fees, which fed a crazy bonus culture that was all about quantity, not quality. And that led directly to this. Lending standards just went out the window. To keep feeding that hungry machine, lenders started giving out what they called subprime loans. We're talking loans to people with terrible credit, sometimes without even verifying their income. A lot of these loans had these tricky, predatory terms, a low starter interest rate that would suddenly explode a few years later. They weren't just loans, they were ticking time bombs. But did the investment banks care? Nope. To keep the whole thing going, they invented an even more complicated, even more dangerous product, the collateralized debt obligation, or CDO. They would take the absolute riskiest, most toxic subprime loans, the ones nobody else wanted, and bundled those together to sell to investors around the world who just didn't know any better. So you just had this complete systemic failure. Lenders didn't care if people could pay, the investment banks didn't care about the risk they were selling, and the supposed watchdogs, the rating agencies that were meant to be the impartial referees, well, they were getting paid by the very banks whose products they were rating. So what did they do? They slapped a AAA safety rating, the highest one you can get, on these bundles of toxic time bombs. The whole system was a giant house of cards, all built on one single belief, that housing prices would never, ever go down. But it was just a matter of time before that belief shattered, and all the dominoes started to fall. And when it happened, man, it happened fast. In 2007, those subprime loans started to go bad. By early 2008, foreclosed homes were flooding the market, which finally caused housing prices to fall. Suddenly, those mortgage-backed securities were completely worthless. And then came the moment that changed everything. September 15th, 2008. Lehman Brothers, a 150-year-old giant of Wall Street, declared bankruptcy. And that's when total, absolute panic set in. And get this, just let this number sink in for a second. 70%. 70% of those CDOs that the rating agencies had labeled AAA, as safe as you can possibly get, ended up defaulting. They weren't just a little risky, they were fundamentally worthless. The ratings had been a complete fantasy. And this is what that panic looked like. Investors saw what was happening and pulled their money out of everything, absolutely everything, and just ran for safety. The stock market lost about a third of its value in a matter of months. The entire system that allows money to flow through our economy just froze solid. The disaster was no longer just a Wall Street problem. The financial system is like the engine of the global economy. And when that engine seizes up, well, the whole world ends up paying the price. The human cost was just devastating. Businesses that relied on everyday loans to make payroll or buy supplies suddenly couldn't get any money. In the US alone, 2 million jobs were just gone in only the last 4 months of 2008. And of course, countries all over the world that were tied to the US economy got dragged right down with it. So what happened next? Well, in a decision that is still incredibly controversial, governments around the world stepped in and bailed out the exact same financial institutions that had caused the whole mess. The thinking was that they were just too big to fail. New laws, like the Dodd-Frank Act in the US, were put in place to try and stop this from ever happening again. But the economic pain from the crisis would be felt for years and years. And that really leaves us with this final thought, doesn't it? At the end of the day, this crisis wasn't just about complicated finances. It was about human behavior. It was about greed. And you would really hope that we wouldn't need a global catastrophe to remind us that greed should never, ever be allowed to trump basic common sense and decency.